the dream of any investor, I don't care if it's real estate, equities, is to seek asymmetrical returns. And what do I mean by asymmetrical returns? Is there a place on that graph where, and I'll call it the upper left-hand corner, where you can get equity-like returns with lower risk? That is the dream investment. Can I find a vehicle where I could get equity-like returns with the lowest risk?
Dean, welcome to the show today. Thank you for joining me.
Thank you, Chris.
I'm going to come out hot. 10-year treasuries ripping up. I've listened to you speak 3 or 4 times, and I'm just going to throw a broad question out there, which is, what are you thinking right now?
We have a capital market environment that's in turmoil. And in the real estate space, even though fundamentals are relatively pretty good, except for office, where there's been some real structural obsolescence, the industry's in disarray because for 20 years, we lived in an environment where interest rates were low, and whenever you would either buy or develop, your yield exceeded interest rates and cap rates. And today, you're in a negative arbitrage situation. The interest rates and cap rates are greater than what you would either buy real estate at or develop it. So things have completely gone upside down. And the second transformational component is that, assuming many groups or owners borrowed at 3 or 4% 4 or 5 years ago, and now their loans come up, and because of the increase of the rates from 0 to 5.5%, the short-term SOFR rate, they now have to refinance at 8 or 9%, assuming they don't want to lock in long, when their current loan was 4%. And so you can't borrow enough money based on the higher debt service to pay off your old loan. So you have a whole industry. And then the final factor is the normal source of lenders, the banks, CMBS, even the Wall Street debt funds are pretty much all sidelined right now because of this capital market upheaval. So even if you could borrow, other than Fannie and Freddie, the sources of liquidity have been significantly diminished.
You've been through multiple cycles. Is there one that you could compare this one to? If we just went back to 2008, and a lot of folks might say, oh, well, the banks are better capitalized, they're not as levered, it's different this time. Are there similarities, or is this very different?
There's similarities that in 2008, you had the capital market meltdown. No one had money to lend. And even if your banks are stronger today, they're not lending because of the anticipation of taking, revaluation of their assets and higher regulations on banks today. So on the one hand, very similar that you don't have the liquidity from the capital markets. The difference and why this period actually may be one of the most great periods of new investing of all time is in 2008 and 9, the whole system was broken. There was no investment grade, and many of the assets really decreased in value because people lost jobs, there was no demand, rents went down. Here is a different period. In 2023, put aside office, fundamentals are really pretty okay. They're not roaring, on the multifamily front. Rents are not going up 5-10%. They're flat or going down. And there's new supply coming in, but it'll get absorbed because nothing new will get built. Industrial still is pretty okay. Grocery stores are excellent with open air centers, not necessarily malls. The hotel industry, peaked a little last year post-pandemic, but it's relatively stable. So it's interesting here because you have a period of capital market illiquidity, but yet fundamentals okay.
And if we go to the loans coming due, I mean, the obvious is your loans coming due, you either need to refinance it or pay it off. Assuming that, though, and assuming this kind of tidal wave of this coming over the next few years, like if you had to have some insight into how that might play out, is this going to be a lot of people dropping deals? Is this going to be banks kind of extending and pretending? How do you think banks will be thinking about this as these are coming up for renewal?
Yeah. So, first of all, the goal of any borrower, extend till 2025. Okay?
Stay alive till 25.
Stay alive to 25, where you're hoping 24 months from now, the short-term rates, go down to 2.5, not 5.5. You borrow normally 200, 250 over. We're never going to, I don't believe we will ever see the period of the zero interest rates that we had for about 7 years. That was, for artificially induced. But could we go back to an environment where the normal borrowing rate is 4.5 to 5, which is really the rate I lived with most of my career? Yes, you can make things work there. Okay. But you may not see that for 18 to 24 months. So the first goal is, how do I push out a few years? So when your loan comes up, the first thing you have to say is the best lender you have is your existing lender. Okay. So if you don't have to find new capital, pay the money, pay them off, if you can get new lender to extend, that's goal number one. Okay. Get 2 more years, whatever it costs. But even to extend, you may have to buy a new SOFR cap. It'll be at double the rate. The lender may want to pay down in order for you to extend. So you're really going to need gap financing, refinancing, gap financing. But one idea is just to go long where the rates may be 6.25, not 9. But oftentimes people don't want to go long and lock up their assets for 10 more years. So they have to go short. The short-term rates are high. So you're going to have a lot of situations where I'll call it the gap refinancing opportunity, which is, let's say, at a $40 million loan before, now it's $30 million. What you could get, but we have to pay down, so you need $10 million. You could go to your investors to get it, but they're typically not going to ante up. So you got to go to the world of either borrowing money from preferred equity or mezzanine. It may cost you 15%, but that 15% may only be for 2.5 years, and you may just bite the bullet to get you to 2025. Because you can't sell the property today. Because remember, if you go to sell your property, the new buyer is going to be trying to buy your asset with a 9% debt rate at 55%. The new buyers can't make their numbers work in order for the sellers to get their price. So you have a total standstill on the what I call sale market. You have a total standstill on new development. Tell me why people were building apartments at 5.5 before. So going out 3 years to a 5.5, 6% yield. Why would you build new to 5.5 and 6 if my floating rate debt is 8 or 9? You have no idea where your cap rate is. You're in a negative arbitrage position, which means activity is just going to be stalled until you have a movement in the capital markets.
I want to describe a situation and hear what you think on this. So a lot of folks think, well, I have locked in low fixed rate debt in the high 3s, low 4s. If a bank has that on their balance sheet, that's probably not good for them. It's good for the borrower, not good for the bank. I think covenants that were overlooked for the last 20 years are actually going to start making their way. And if a bank can foreclose on somebody that busts a covenant or at least create a way for a pay down, you might see a lot of these low fixed rate loans start becoming actual issues for the borrowers. What they thought was their best asset might become something that is a thorn in their side. How do you think about that?
Interesting. The banks have so many real issues. They have to play around in the 3 to 4% loan. It's not where their manpower should be. So yes, could they play with you in that? yes, the truth is there are bigger issues as having loans coming due. They can't get refinanced. And what do you do about that? Because that's a real issue. So do I think the 3 or 4% game will banks be renegotiating if you break a covenant? It may be, but I don't think that's a big business for the banks. And I don't think this is a way for them to make their money. I think they have to deal with what they own on their books, legacy assets, and they got to spend their time cleaning up legacy assets right now. And so I don't think this is the source. I don't think the banks are that Machiavellian. May be wrong. I don't believe so. And I think they're going to focus on those things they should be focusing on. So I don't see it as a big risk.
What needs to happen to start seeing a normalized market? Is it just pricing coming into check and deals penciling, or is there other factors that need to happen for a market to normalize and come out of turmoil and chaos?
Yeah, look, I think the Fed has to be convinced they've tamed inflation and get to a point, which is not going to happen this year, of starting gently lowering the rates. Because look, you have two situations now. Both the rates went up and the spreads ballooned. Okay. If you look back at spreads in 2008, or in other periods, they've been much narrower. You had a double whammy here. You had the base short-term rates going from 0 to 5.5, and you had the spreads ballooning. And I mean, it's crazy. You get to 5.5, and then you want to borrow for a normal loan. It could be 400 over. But 5.5 with 400 over, that's 9.5. By the time you pay your cap rates, you're at 10.5. And you're only borrowing 55%. So the other 45, if you can find that equity, is going to be a lot more expensive because it's lower debt, lower returns. So that's why you see out there the most preferred asset class for investment is in preferred equity, private credit. And the whole private credit area is just amazing right now. Look, in any investment business, we talk about risk return. And if in real estate you say, okay, the lowest risk is senior loans, then maybe preferred, then core assets, then core plus, then value add, then opportunistic, then development. And you go up a curve, a risk return. And that's sort of a normal setting. If you go do development deals, obviously the only reason you do them is you think that the returns are highest, but you also take the highest risk. Well, the dream of any investor, I don't care if it's real estate, equities, is to seek asymmetrical returns. And what do I mean by asymmetrical returns? Is there a place on that graph and I'll call it the upper left-hand corner, where you can get equity-like returns with lower risk? That is the dream investment. Can I find a vehicle where I could get equity-like returns, upper left-hand corner of the graph, with the lowest risk? And I've been investing for 40 years, and I've rarely seen that scenario. Okay? Very rarely. Well, guess what? Today, you see that. So let's go back to the original model we had. We said someone had a $40 million loan. Probably the asset was worth $60 million. They can only borrow $30 million today. So you need a $10 million slug. So that $10 million slug is between 60 and 75% of today's value, not 22's value. So you're in a period where you could come in at today's value, which is lower, and go between 60 and 75%. What's different today is what you could charge for that piece. So if people are doing senior loans at 10, you can charge 13, 14, 15% for that piece. So one could earn 15% between 60 and 75%. So your risk is lower. I'd rather be at 60 to 75 than 75 to 100. so you risk lower from getting equity returns. Okay? That to me is what I'll call the ideal scenario. Okay? Now, you may say, but Dean, you know what? Okay, if you get it for 2 years, that's fine. You got a little better return for 2 years. But as things cycle through, okay, you have reinvestment risk in 2 years. So it's a good little niche, but it's very short term. The key to the strategy is what I just said, the short term. How do you create an investment instrument between 60 and 75 that has duration today? If you could go write that, or could have 5-year or 10-year paper, okay? That piece of paper you're creating has a 13.5% or 14 base return, and the duration gives it a lot of value, because if someone needs to pay you off in 3 years because of the duration, you have a lot of upside in the duration. So we're focused on, like in the multifamily space, taking that preferred, linking it to 10-year Fannie or Freddie paper, so we could get the 13.5% for the next 3 years. And if rates ultimately come down, I have 6 years of yield maintenance to sell. So you could prop that to an 18, 19% rate return by going into the preferred equity position today. And so the key is not just to play private credit, preferred equity. It's what asset do you play in? And number two, how do you create more of a longer term duration so you're just not a stopgap? And that is the goal for what I think, the people who really do well today has to have that mindset, not just to trade in and out. Because to trade in and out sounds good for 18 months, but if they pay you off and that's all it's for, it's not worth it.
And I realize it's all just a negotiation, but is there a reason why y'all might be able to get 5 or 10 and there's going to be other groups signing for 18 months or 2 years? You're just asking for 10, or is there something else?
No, there may be borrowers who are saying, if I float, the rate's 8.5, okay, or 9. The 10-year with the 10-year treasury paper, maybe 6.25. Okay. So you know what? Even though it's not great, I want to lock up my real estate. I want to own longer term. Other people may just be, man, I just want to extend and get me to 2025. And so, which is great when the rates hopefully drop and I could sell my position then. So then, if there is a ability to prepay you in a shorter period of time, you got to put in bells and whistles to get paid for the short duration of where you're putting your money in. And that's where the art is. How do you structure it so you get more duration or get paid for making someone pay you off early?
Are you seeing, like at Lubert-Adler, are y'all raising a fund dedicated to that? Or are you seeing folks that maybe had equity funds raised kind of rewriting their docs and now allowing them to kind of enter the private credit space? How is this going to form up so quickly?
But if you had equity funds and you could go get a 15% rate return at a lower risk, I think it qualifies for the equity funds. The equity funds, whether you're preferred equity or common equity, you're still equity. And what's wrong with trying to get a 15% rate return with lower risk in your equity funds? Number two, we are creating our own private credit pool. But the key for equity groups like myself is we may underwrite equity well, but every equity player thinks they could be a preferred equity or lender by just switching a switch, and you can't. So we went on, and we have brought in what I think are some of the best capital market people in the marketplace. We brought into our firm so we could combine the capital market expertise of people doing it every day with a common equity approach that we've had, or a preferred equity approach, which has been really our business for 5 years. And it's the combination of the two that make for what I'll call, a strong pool of capital. And number two, you got to do it so you're creating a business longer term. just to create private credit for 2 years, it is not a business you want to be into. So you got to be able to take advantage of the situation, but then as the industry evolves, continue the business. Because anytime you're in the investment business, you're looking to build a business and not just a trade.
Yep. Okay, let's role play a little bit. I come to you, I say, Dean, I've got a multifamily deal I bought in 21. I'm getting squeezed, and we'll go back to that situation you just described, and I'm going to need some private credit. What are you asking me? How are you vetting who you're going to give money to and what situations you actually want to put money into? Because we can assume there will be a lot, and you're only going to do a few of them.
You got it. So number one, the real estate business, it all starts with the people, okay? Borrowers who are high quality organizations and people who've respected their partners over the years, who are in it for the long term and not syndication, who have their own money behind you, and who are not looking to cash out. I would never do a preferred and let someone cash it out. That's a no-no for me. So it all starts with the quality of the borrower. And here's the beauty for us. In the CMBS world or the Wall Street world, they make it in a mezzanine with the UCC or CMBS type product. And as soon as they make that investment, they have the ability to syndicate it. They take it off their books. And so therefore the borrower is going to deal with some servicer, some 26-year-old kid, some servicer they don't even know. And if they ever have an issue in 3 or 4 years, they're dealing with, there's no relationship oriented. We're in the relationship business. And so we're going to keep these positions within our shop on the book, old fashioned real estate lending. And so the borrower will know, or the common equity will know, that the people that's on the phone are seeing them today, the people they're going to see in 3 years. And for me, that's really been critical. I've been a big borrower with the banks and not CMBS because I believe, if I'm working with Wells Fargo and they make me the loan, they're going to hold that loan. And if there's ever bumps in the road, we can go sit down and work things through. If it was CMBS and all of a sudden the servicers there, they have no relationship with you. They have a goal to make your life miserable for 18 months. They're in the fee business, and then move it along. They're not in the business of, and real estate's a long-term game. So that's step one. Step two, the form of the, what I'll call the recap capital. Mezzanine, which most Wall Street people like to use, is 3 years, 15%, get a UCC, and if your business plan doesn't work, in 90 days they could own it. Well, if I'm a borrower, it's a little scary, okay? Don't love that. And number two, if you don't have cash flow for 2 years, all of a sudden you owe this mezzanine 1.3, 1.45 times. So the common equity becomes a zero coupon bond. So those positions are out there, but we take a different approach. We treat our money as following. I call it common equity with a liquidation preference. And what do I mean? Let's assume the loan's $40 million and the preferred is 10 and the common equity is 10. Okay? So I say, hey, we each have 10 million up. We're going to go 50-50 on all cash flow. I'm going to allow leakage to the borrower as a preferred, participating preferred, so that induces the borrower to keep infusing capital below me. If they have no chance to get any cash flow and they're a zero coupon bond, they cannot attract capital that'll be subordinate to mine. So we go 50-50 on cash flow, let some leakage go through. And then ultimately, when there's a refinance or a sale, we say, hey, as long as the deal did better than 12.5 IRR, you keep your 50-50. However, in the event it's less, we're going to have a liquidation preference of our capital plus 12.5. Then, Chris, you would say to me, well, Dean, the common equity, they give you this preference. What do they get in return? and I give them a bigger promote on my money. So I said, rather than we each own 50-50, if I have a liquidation preference of my money in 12 and a half, I'll take a 20% kicker above that on the profits. And so basically I'll give up more upside in exchange for downside protection. But it's preferred equity. So if they don't hit their targets in 3 years, I can't just UCC them. And here's the second big point. I like to, if I have quality borrowers and I believe in the asset, I want to work with that borrower because I think we could bring value creation skill set to make it better for all of us. If I'm a mezzanine player, you're not allowed to deal with the borrower. Lender liability, stay away, I'm a lender. I want to be a preferred, really common equity with a liquidation preference so I can help build value with the borrower. And here's the interesting statement. Years ago, I was asked to invest in a distressed debt fund to do mezzanine pieces in Europe, okay? And Lubert-Adler did do it, but the group I liked a lot, and they had a team in Europe, so I personally invested. So they go ahead and they buy into the debt. It's, they're buying it at 60, 70% of value, and they buy a few $1 billion of this, and they buy their position. Then a year later, they sell all the loans, and they earn a 20% IRR. So the head of that company called me and said, hey, Dean, are you available for round two? We gave you a 20% IRR in round one. And I said, no, I think you did a terrible job because I got a 1.2 multiple. I'm paying ordinary income tax. I got a 20 IRR, but a 1.2 multiple. I said, what you missed was that you were accessing this real estate at a great access point, at 75% of the value. What you should have done was work over time to take your advantageous position, work with the borrowers, and then upon the recovery, add value creation skills and make the assets better. So you get the best of the world. You get in at a lower cost basis and you ride the upside through value creation skills. I would much rather earn a 17 IRR and a 2.2 multiple over 5 years than earn a 20 IRR with a 1.2 equity multiple. So one of the reasons we do the preferreds with our borrowers is we want the advantageous cost advantage of being between 60 and 75%. But I want to work with the borrowers that upon things of recovery, I want to work with them and share part of that upside. So that goes back to my same thesis of asymmetrical risk. If I could be in a lower cost basis today to protect my downside, and I could help ride the recovery up on the upside, can I get equity-like returns in the 60 to 75%? And you can do it most advantageously through a preferred equity concept, which has been our business, than the strict mezzanine. And here's the last piece. Everyone loves secondaries out there. Secondary. So, the institutions invest in the funds. And if they don't like it for 5, they could go and have a secondary. And people, brothers, sisters, cousins are all raising secondary funds. So when most people do their preferred equity pieces, they put their investments in, and then they go on to the next deal. Then they go to the next deal. Then they go on to the next deal. What I'll call the family and friend, the individual marketplace has no secondaries out there. Like the B REITs for Blackstone. There's no secondaries for those people. Okay, they're stuck. Good, bad, or indifferent. They're stuck. When we do a preferred equity into a deal, and remember my example, 40 of senior, 10 of our preferred, 10 of theirs. Once you're in and you understand the asset better, you have an opportunity to approach the limited partners from the old, from the former deal and say, by the way, we're thrilled to have you in and we're going to work this over the next 3 to 5 years. And I hope we all win. But in the unlikely event you want some liquidity today, here's 35, 40 cents on the dollar. So the beauty of these preferreds, let's say you're initially marking at a 15 rate return, you have a secondary opportunity over time. If you can value the asset, you can, but you're not going to make it obligatory. People have the right to stay in. But if they don't, you could create your own secondary business on these preferreds, and they have what I call second bite of the apple. And so to me, and it's not anything treacherous or anything, they're totally permitted to stay in. But you find for a lot of reasons, people say, I don't even know how I got in that deal in the first place. I don't even know what the property is, but someone got me in. And yes, my life's changed. I want some liquidity. And even though, this is not a perfect market, we'll take the offer and move on. So you always have to be thinking in this business of the assets that you know best are the ones you need to try to capitalize on. And when you're on the inside of an asset where I'm already have an investment versus being on the outside, that's good. And that offers more opportunity. So you have to keep thinking through the different components and how do you get my job is to get outsized return while always mitigating the risk. That is our total business.
If I come to you and you say, okay, I'm in your deal, should I have already gone to my common equity that I started with in my lender and said, I'm trying to do this deal and get their permission? Or do I get your permission first that you're in, and then I go get permission from the parties that are already in?
Well, make this easier. First of all, the lender wants a pay down, right? So they love this, okay? Especially if it's preferred and not mezz. There's no intercreditor agreement. And we structured ours as common equity with a liquidation preference. We're the dream to the lender. So now, how do I deal with the limits, right? So the limits can say, oh my God, a 15% piece of paper is paying down the debt. I'm behind 15% or whatever this is. I don't like it. And by the way, so you know how to deal with that? You give everyone the right to co-invest in the same terms. So to the limits, I say, hey, you want half the action? Feel free to write your check and you get the same terms as me. So as long as you provide the existing limited partner base the same right to invest, that's really fair. And we are happy as long as we control at least half the piece. We're delighted for the limiteds to invest in the piece. Come along. And to me, that takes away the conflict. And as long as people know they have the right to do what we're doing, they're on board. And if you don't give them the right, they can object, and then it gets ugly for everyone. Not for us, we're already out of there. But so to me, the right to bring people along is the best way to deal with it up front, because everyone has the same opportunity to participate.
Okay, I want to move to maybe a little more discussion on just asset classes, and I'll start with the big one in the room. Now I come to you and I say, I got a busted office deal, which I think we can kind of put in its own category now. With multi, at least you're probably thinking, yes, there's people that are always going to live here. This is a market. Office is a little different. Maybe we'll just start with, how are you thinking about office? And I know there's different types of office and classes, but when I say office, what do you say?
I say today, it's a very difficult asset class to evaluate. There's significant amount of lack of transparency, uncertainty, and I'll go through that in a minute. And because of those factors, it's a difficult place for us to play in. So, for example, a building may be 90% leased today, 95. But when you walk the floors of the building, you see only half the space occupied. So even though you may have an 8-year WALT, where that's the average term of the rest of the building, you're sitting there and saying, what's the likelihood of these tenants renewing if they're only utilizing half their space? How do you underwrite that? Okay. So number one, until we have greater transparency on how many days a week people come back to work. If people are only coming back to work 3 days a week, you need half your space. And why are you going to build out all these fancy offices? They sit empty half the time. So number one, I don't believe we have enough transparency to make that call. Now, you could argue that Europe is substantially back in terms of occupying their office space. So it's just a matter of time for the US to fall that way. Maybe, but I don't know. So number one, very difficult to underwrite with conviction. And my belief is there's so many other places to make money today. Do I really need to take that risk? Number two, you have very unfriendly capital markets. You're not going to buy an asset and get financing. Now, what you could do is, if it goes back to the lender, like I said, your best lender is your existing lender. So you cut a deal with that lender, takes back paper for 5 years. Number three, I will say this, office is not going away. Maybe the amount of office is going away, but office itself, you're still going to have people working and going to the office. So you're going to have a tendency for the better buildings, I think, to survive. The commodity buildings, will get crushed. There's probably no room for that. But there will be office space, office tenants. It's just not going to be, at the level that we've had in all these years. So, will someone or some groups make money in office? Yeah. Okay. They'll plow through the next 5 years and come out the other end. But there's another, Chris, fundamental mispricing of office. And I've been talking about this for 40 years. No one really seems to listen to me, but I will articulate it again. In multifamily and industrial and retail and hotel, you take a multiple of the net operating income. Okay. So if you have a $10 million net operating income and it's a 15 times multiple, 12 times multiple, the property is worth 120 million. And the net operating income is after reserve. So if I have 10 million of NOI, I get 10 million to pay my bills. Okay. So the cap rate is really off of net cash flow in the asset classes I just articulated. The office is completely different. So if you have 10 million of NOI, but you have tenants rolling every 2 years, the level of tenant allowance and leasing commissions soak up your cash flow. So even though your NOI was 10 million, your average net cash flow is 7 million. Okay? Tell me why the business for the last 30 or 40 years was not doing that 12 multiple on 7 million, which would be 84 million versus 120 million. There's been a huge disconnect between net cash flow and NOI. And now the argument must be, well, the tenant allowance you put in, you're going to get higher and higher rents. So as you do the annual tenant allowance and the leasing commissions, you get higher rents. So you were creating value on the top line by putting in that 3 million a year below. I'll make an argument today that whoever's putting that money in today, you probably, unless you're in an extraordinary market, you're in Miami or, you're the best of the best, that the bottom line 3 million is almost an annual expense to stay even. And if it's annual expense, you got to start capitalizing net cash flow and not NOI. And that is a differential of probably 400 to 500 basis points of cap rate. So to me, until the industry sort of sees it the way I do, and I can't pay bills of NOI in office because my below the line items are so high that you need to capitalize cash, net cash, and not NOI to pay your bills. And so I think you have that. And I think it's going to be difficult. I think you have to go to that point because I don't think the tenant allowance and leasing commission in a market of excess supply everywhere is going to mean higher rents. I think it's going to be flat rents. So if you're going to have flat rents, You got to treat it like annual expenditures. And that's why even if you go to the public market and you look at companies and people do a multiple of EBITDA, well, there's a big difference of multiple of EBITDA where the capital expenditures below the line represent 10% of EBITDA. But there are plenty of companies that below the line could be 40% of EBITDA. So, why aren't I doing it? Not at EBITDA, but again, a net cash flow, the multiple. So to me, the office building market not only has its own structural impediments on, how many days people could come to work and the impact on supply. I think they're going to have some rental adjustments. And I think the whole nature of buying office buildings have to shift from a multiple of NOI to a multiple of net cash flow. And that'll be significant. And I think once it starts adjusting that way, then maybe you can start looking at it. But until they adjust it, you can't buy these things. And finally, one of the benefits of real estate, whether it be multifamily, the industrial, is the ability to generate some current yield. So if you're targeting a 15 IRR, if you could get 6, 7, 8 in current yield and 8% on the back end, it's a nice balance. And when you go through downturns, it's been those type of rental assets that rebounded the best, which is always your theory. When you go through a downturn, how do you make out? Versus what I call a back-ended asset. A back-ended asset is like office. If you keep putting money in every year, you have no cash flow. So you're waiting for years 5 and 6 to sell it. All your return is back-end weighted. So to me, I don't like the balance between cash flow and appreciation in office. It's got to enter into the rental asset class, which it hasn't yet, which also gives me one more thing. I'll call rental assets versus discretionary assets. A rental asset, you need a place to live, multifamily. You need a place to shop, the grocery. You need some industrial to distribute goods. You need some hotels. Well, there you have rental assets. People need a place to live, work, and shop. And there's a rental stream. And what I found in the last downturn, 2008 or 9, rental assets got hurt, but they rebounded. Okay? And I'll call them necessity assets or non-discretionary assets. Now let's go to the discretionary assets. Second homes, condos, residential resorts, land, okay? When the downturn occurred, there was no floor. They're discretionary. Who needs a second home, okay? Condos are sort of scary. It's all in the back end. There's no cash flow. So when you go to sell, if you're in a good period, you make money. So people in Miami made some money. People in New York with the condos, when you hit a tough market, they sit there, okay? So it's all back end weighted. So the level and in the downturns, there are no floors to these discretionary non-necessity assets. So if you are a big believer that you got to create a portfolio of 90% winners and avoid losers at all costs, because the losers destroy you. You can't have 50% winners and 50% losers. You need 90% winners and 10% break even. That's a portfolio you need. That's called portfolio composition. If you believe in that, then the selection of the type of asset, rental assets versus discretionary, is a critical component of your investment thinking.
So Charlie Munger calls EBITDA bullshit earnings, and you're calling NOI to office buildings bullshit earnings.
Yeah.
Okay.
Why not?
All right. Somebody told me the other day, and you probably can fact check this or know this, that 30% of most institutional capital has flown to office and coastal markets. So if you look at the total allocation to real estate from institutions, a lot of it is sitting in these office buildings. Maybe it's 30, maybe it's less. How will that impact this next cycle when all this institutional capital is in what we're calling a really troubled asset where it's hard to define what to do? Like, I guess, how does that impact the market, or does it?
I'm not sure it impacts the market. I think it impacts the mark-to-market on the institutions. And if their goal was they had to earn 7.5% to meet the pension fund needs. I think you have to accurately mark the assets. But just going from NOI to net cash flows are marked, let alone the lack of liquidity, you can't sell for 2 or 3 years. I mean, there's no buyers. So I think whether it be the banks or the institutions, look, in my early part of my career, there were only 2 asset classes. Interesting. It wasn't multifamily industrial. The big institutions threw up on that stuff. They were thought that was stuff for like scrappy people like me. Okay. They needed to put big dollars out, and they went to office and malls. Okay. And that was, growing up in this business, those were the big institutional powerhouses. We couldn't play in there because the institutions were so big in there. Interesting. The malls went first, and you had 1,200 malls in America. You have probably 200 left. They're real malls, okay? And even if some, what I'll call B malls are operating, it's just a matter of time. The day a landlord says they're not going to invest in that mall to buy a tenant in, it's over. And so, say 200 buildings. The good fortress malls, yeah, those are terrific. They're also owned by a few players. I mean, Simon has a terrific portfolio of fortress malls. Peter Lowy had them. Westfield that he sold them. So those assets to me are, the 200 are gold. We talk about 1,000 of them that are gone. Okay, and you're going to have some of the same issues with office. You have big holdings in office, but really the Class A plus buildings, yeah, they're actually getting the better ones. Okay, you go to New York City and Vanderbilt and 425 Park and Hudson Yards, the best of the best get tenants. Okay, but that's only 10% of the stock. What are you doing all the rest of the stuff? Where you have a hot market in Miami, an office, or Steve Ross creating new Class A office in West Palm Beach. You got demand. But the other thing that I want to focus on is, in looking at assets, we're in the business of leasing space. Period. I don't care what it is. What are your demand generators? Look, there can be oversupply in markets, but eventually people absorb supply. The most important thing is, and John Gray says it great, be in the right neighborhood with the right asset class. Have the demand as a tailwind, not a headwind. So we are a firm believer, whatever we invest in, I don't want to be just a low-cost provider and playing the rearrange the chairs on the ship, the Titanic, on buying people's tenants over. You got to be in a market where you can see future demand. You got to start there. And what is demand? Demand means population growth, the right demographics, et cetera. So demand is everything. And if you're in a market with the declining demand, you're never going to get that phone call and say, hey, when the phone rings, you don't want to answer it because it's got to be bad news, okay? So you want to be in a market that you could look out 5 to 10 years and there's demand, or an asset class. That's a really important part of the way we look at things.
Do you think there's an asset class that exists today that nobody knows is dying? Like you could kind of say malls did it. You could kind of say big box retail is kind of dying a little. Maybe we could throw office in there. Is there something else? Maybe it's this Airbnb world. Is there something in your mind where you're like, this thing's dying and nobody knows it yet?
So, and this is an area that I don't know about, but I'm just, experiencing it here in Philadelphia, the life science space. So on the one hand, you say life science, healthcare, biotech is growing, good business, okay? So people went on a rampage in building life science buildings at big cost bases, whether it be in Boston, in the MIT area, which is great, San Diego, Philadelphia outside of Penn, and you had this mad surge into life science. But then you have to say, who are the real tenants in life science? So you got the big pharmacies and the pharmaceuticals, and those are strong. The problem with that is they're so strong they could build their own buildings. So why go with the developer when you can build your own building? So we see that in Philadelphia right outside my window. Sparks Therapeutics. They start as a tenant. They need 1 million square feet. They're building it themselves. Okay. And then you get the venture capital ones, the young biotech, and they're around, but they don't have credit. They don't take a lot of space. The big business was that biotech company that went public at a $2 or $3 billion valuation. They had a lot of capital. So they went, when the building was built, they go take the space, and they were very vibrant. Well, when the market started reducing the value of those companies, so they lost 80% of their value, they're no longer viable for tenancy. So the demand for space, even though I like the whole concept of healthcare and growth and innovation, Penn just had 2 of their great scientists, get significant awards for their work during the pandemic. There hasn't been many leases signed in the last 10 months in Philadelphia, in our life science area. And you see the slowdown pretty much everywhere. Is it going to continue, the slowdown? I don't know. I like the space, but I think people got very exuberant on it. And, to me, looking out in the next 24, 36 months, you just don't see the activity yet on that. By the way, when people said retail is dead, retail's not dead. It's just reconfiguring, okay? The e-commerce business is 15%. It's leveling off. Brick and mortar still does 85% of your sales. Grocery, we're obviously very active there in Albertsons, has been solid as a rock. Outdoor lifestyle centers where people don't have to go in the mall, but they can get something to eat, and some of the big boxes that you talked about are integrating themselves into more livable lifestyle centers. They're here to stay. They're strong. People are still there. So interesting, when we said retail was dead, 5 years ago, it's not dead. It was adjusting. And what was most interesting that what the pandemic did was it required those retailers who did not have a good online presence, they were forced to create one or they were out. And like in the grocery business, we didn't have a vibrant online business. But in order to retain our customer, we had to provide a service that if you're in the store or your home, or you could order and pick it up outside. We had to elevate our game in a year period of time when it may have been 5 or 7 years. So I think the integration of brick and mortar and e-commerce became the buzzword. And also you can see many of the e-commerce tenants saying, hey, I need to get some brick and mortars to round out our offering. And by the way, in the grocery space, even though it's nice to say, hey, I can order online, it's, to be in the e-commerce grocery business like Amazon is very difficult, because think about when you package goods. If you go put raw meat next to ice cream, next to hot chicken, it's not an easy thing for a $40 order to deliver and package. It's just a lot more different than if I'm doing e-commerce and TVs or electronics or books where you could just send out from a warehouse.
You own real estate, and you just said the hot word. I've heard you say this before, Albertsons. How is a big real estate fund involved with Albertsons? If you could maybe describe how you got into it, and then a little more about how owning that asset or owning a piece of that asset informs how you look at the world.
I clearly in 2005 did not wake up and say, need to be in the grocery business. We're real estate people. But this is very interesting. So we created a business with my partner, Hirschklaff, where we wanted to buy real estate where the seller or the owner of real estate didn't advertise they were in the real estate business. We wanted to go on roads that others didn't travel on. So where could we go to buy valuable real estate that could be adaptably reused out of the public eye? So we started a business of tracking distressed retailers who may go into bankruptcy, but owned valuable real estate, owned or had long-term leases that were cheap. And, they were retailers, but people didn't focus on what they owned in their real estate. So our first play was Heckinger's. They go into bankruptcy. We buy a few empty stores. And then, by the way, so well located, you're able to release them to better credit retailers. Okay. Number 2, Levitt's Furniture. No one's walking around saying, let's go buy real estate. Levitt's wasn't out. They were marketing beds and couches, not real estate. So we were tracking them when they went to bankruptcy. We said, oh my God, they own some amazing real estate right on the 494 in San Francisco, right on the highway in Paramus. It was amazing. And they're in bankruptcy court. Oh, I didn't see Blackstone or Starwood or, terrific organizations playing the game. There are a bunch of scrappy entrepreneurs playing in this game. And so we'd go into bankruptcy. We'd buy all the Levitz's. Now we own these boxes at $20 a foot. We go to the credit retailers at $8, $10 a foot rent, or we split the boxes, or we level the boxes. And it was a real estate business of buying vacant boxes in an area where the sellers were a bankruptcy court and not hiring East Still to get maximum price. And we would buy these and redevelop them. Then we went to Mervyn's, 276 locations in California. Amazing real estate. Some were connected malls, some were outside. You had a Mervyn's in Irvine at a $2 rent when it was a $20 market. And there, what was interesting is we teamed up with Cerberus and Son, because Mervyn's was an operating business. So we had to have a group operating the business while we looked to maximize the real estate. So you would look for those situations where Mervyn's was not performing well, but the real estate was amazing, okay? And finding situations to maximize both the business and real estate. Then we did some of this in Shopko. We did, and this is crazy when I say this, 170 million square feet of buying distressed real estate from retailers in bankruptcy. 170 million square feet is the size of the Simon Reed. Returns were extraordinary. So in 2005, we looked at this company called Albertsons. At that time, 600 stores Albertsons. There was another 700 store package of Albertsons that wasn't available. We looked at Albertsons as a real estate play. 600 locations that over time, we would vacate those locations and release them to other grocers or other users. And over time, liquidate the 600 stores and release them to more vibrant retailers. And in their case, Hirsch and I, since it was a much bigger deal, teamed up with Kimco, the public REIT, and Jay Schonstein, amazing operator of these type of stores. And we said, okay, of the 600 stores, let's take the first 300, we'll close them and go release them. So we sold a bunch to Save-A-Lot in San Francisco. We closed the ones in Florida, which overall may have been a mistake. It was, those were good, and we released them to Ross, Marshall, Bed Bath & Beyond at much higher rates. And by the way, since it was 600 stores, we found the former operator of Albertson and said, do us a favor. Well, we play real estate renovation, these 300. Just operate the other 300, and then we'll call you in 2 years, okay? So we buy these assets cheap, we renovate them, and after 2 years, we call Bob Miller, old-time amazing operator. I said, Bob, it's time for us to take the 300 stores. Thank you for operating them. You saved us a lot of money. And now the real estate guy's got to do what we got to do. And he says, Dean, before you just want to close and release them, I want to show you something. We're making a shitload of money. I said, what do you mean? We didn't give you any money to operate. He goes, I use my old, my skill set, and we're making money. So all of a sudden we said to ourselves, hey, maybe there's an opportunity to build this up. So the 700 Albertsons that we didn't buy, and these were the good California stores, we ended up buying them. So we had started with 600, went to 300, found out we could operate because we have this great team, bought another 700. All of a sudden, we're in the grocery business. 1,000 stores, good operation team. By the way, a crackerjack real estate team. We were doing the same thing on the real estate. that we were like on Mervin's, where the real estate assets that could be upgraded from, we had a Shaw's in Boston, right across from Fenway Park. Well, it's a development site. We have several of those in DC, several of those in California, Santa Monica. So we still work the portfolio from real estate, but we were really running the business too. And then in 2014, the David and Goliath, the David, our group, goes after Safeway. And in a $14 billion deal, we added 1,400 Safeway stores. Now we're a 2,300 store chain, 275,000 employees, 76 billion in revenues. We're the second largest private company. And then we took the company public about 3 or 4 years ago at a $16 value, which was our value was $3. Okay. And we took it 16. And then ultimately, we brought in some additional management team who've done a marvelous job. And in last October, we entered into agreement to sell the company to Kroger, effectively at about a $35 value. And now it's subject to FTC approval. And so this is just public information. So the FTC is reviewing whether they'll approve a sale to Kroger or not. And we'll see. So, we'll see what happens. And we're all hopeful, but, we'll see. But it's been a 14-year ride. We've had a great investor base who stuck with us as we kept creating value. But it goes to the point I said earlier. As you grow in this business, you just don't want to be a deal shop. How can you use the platform and infrastructure? It gives you the competitive edge. In anything we do in this business, what's my barriers to entry? What's my competitive edge? And when I have a platform of 2,300 markets, I can look at any grocery business around the country. I got superior knowledge. I got an operational team. So when we evaluate any retail center with grocery, no one can compete with us because of the knowledge we have in Albertsons. So you could use it as a strength. So when you could build a vibrant infrastructure in a platform to do additional transactions off of a platform that you have a competitive edge is the way investment vehicles should go. If you're just in the one-off deal left and right doing that, it's a hard way to make a living. So this has been an evolution of the Lubert-Adler funds to say, where's the fulcrum point? If we have a good idea and a good concept, where can we join it so we could replicate the investment success on a larger platform basis? But when I was 25 years younger, I had to look at everything. Okay. And that's the way you made a living. But as you grow into this business over time, you learn that number one, you need a competitive edge. Number two, you need execution, local execution. Every time I see a New Yorker doing a deal in Miami or LA, I say, doesn't make sense to me. Local people execute better. I want to team up with the best of the best. Number three, people matter. People count. Who you do business with, creating relationships is the way to build platforms together. And so you got to stick with the fundamentals. And once you have the fundamentals that gives you that risk mitigation component to protect the downside. And then you try to create your value through your value creation skills.
That is one of my favorite real estate stories I've ever heard. I've done 312 of these episodes. I have a question. Do things like that still exist? You said you did this in 2005. You obviously proved there was a model to look at public companies for their real estate, not their business. You've heard more of these stories over the last, 18 years. As we sit here today, would you say like an opportunity like Albertsons even exists anymore? Or is that arbitrage kind of gone?
Well, when the retail space, very difficult. Because you need new retailers to take the existing space. So one of the beauties in the 2005 up was the growth of the power retailers, Marshalls, Roth, Bed Bath, who unfortunately went into bankruptcy. Okay. You had big growth of that 20 to 40,000 square foot user going along with you. In today's world, you don't get paid for growth of stores. You get paid for combining brick and mortars with e-commerce and owning your customer. So the business plans for most retailers, now there's retailers like Family Dollar and Five Below, they grow by stores. But the business plan for the big boxes, and it's not necessarily let's open 100 new stores. It's, you know what? We have to integrate e-commerce with brick and mortar so that we do a better job for our customer. That's what's given credit. Building more stores, not. So even if you bought a retailer and you got at a lot of cheap real estate, the ability to refill it today is much more difficult. Okay. So I'll give you some other examples. So the ability to refill it today, you don't have 10 retailers lined up to gobble the space. Now you could say, yeah, but Dean, well, you know, what about buying the real estate? Why not buy Target for the real estate? Or why not buy McDonald's for the real estate? Well, that doesn't make any sense because Target and McDonald's are already maximizing the use of their real estate. So it's not like you're going to take Target out and put someone better in. They're already the best for that real estate. Our plan was taking those retailers who are not utilizing their space properly, not maximizing it, and going to someone. So here's what happened. 2020, Toys R Us goes bust. And they have 400 stores. So we brought the teams together again. 400 stores. Let's gobble them up. No one's better than us in this business. So we, Tim Cohen, Sean Steen, and Claff in the same group, Cerberus. When we did the analysis on the 400 stores, in the old days, we would have had a tenant for them. Here, before we did a bid, we go out to the big tenants. And obviously, we have a lot of credibility with them. We've given them a lot of space over the years. And guess what? Out of the 400 locations, we were only to identify 30 tenants that would basically pre-commit to us. So, Burlington and people like that. So we only bought 30. So the days of buying 400 that we did for 20 years, those days were over because you didn't have the new people going down. Then, last piece. So then I said, my God, there's a lot of Sears and Pennies. Who is the growth user for the space? And guess who it was? After 2020, it was Amazon for a little. Amazon was looking to do in 148,000 square feet, 5 regional warehouses, 1 big warehouse. So we took the program and went to Amazon and said, we could access you 150,000 square foot buildings in the right locations by teaming you up for distressed real estate. Okay. By the way, great gig for a year. Great gig. And by the way, you buy these buildings cheap and then they come in with Amazon credit. You're doing Amazon's at 7, their bonds are at 3. I thought that was the business of the future until Amazon called us one December, 2 years ago, said, Dean, thank you for lining up 85 sites, but we're shutting down. We're just not adding more stores. So that gig was an interesting gig for a while. Same concept, pandemic hits. 2021. Who's going bust? The restaurants. Okay. So what did we do? We formed a group there were a lot of restaurants going bad, but then you had the nationals who wanted new pad sites because they needed double drive-through, the Chick-fil-A's, the Starbucks, all investment grade users. So we teamed up with the tenants to form a pool to go after the distressed restaurant pads. A great strategy, okay? And we started looking at restaurants that are closing 200 locations, lining them up with the Chick-fil-A's and the Starbucks and the Dunkin' Donuts. So we're basically buying distressed real estate, but putting investment-grade credit. If I could put a 15-year Chick-fil-A at 7% when the bonds are at 3%, that's a good piece of real estate. The problem is PPP came in after about 4 months and said, Dean, I said to the world, no more of this. We're going to provide, assistance to all the restaurants. So therefore, cool strategy, the right idea of competitive edge, the fulcrum point, everything we talk about. Where's your edge? Have a business, do it in size, replicate it. It was all lined up, except for the fact that PPP came in and stopped it.
Interesting. All right, I'm going to leave you on one question, and we're going to bring it home. You've been in this business 40 years. You've seen a lot. What do you wish you had focused more on, and what do you wish you had focused less on?
Great question. The business I missed in the last 6 to 7 years was industrial. I understood e-commerce and its growth. I never fell in love with industrial because I've always been a big believer that location matters. So I needed the shopping center on the right corner, or I need that office building in the heart of the town. Okay. Industrial was, and maybe the value add execution of a property took value add skills. Industrial always bothered me because you didn't have to be at the right corner. You could be in an industrial park down a road in a forest somewhere. There was no real a lot of value add because it's basically a butler building. It was easier for people to build, easier for people to replicate. So to me, it felt like a commodity. And, and looking back over the last 7 years, there's been a lot of people who've made a lot of money in industrial and elevated to real logistics and found ways to add value. So it was an arena that we participate some. We have a 2 million square foot facility right at the Philadelphia airport, right on rail, right next to FedEx, right next to the airplanes. To me, that was strategic, right on the highway. We're going to buy that. But what I'll call the commodity-like industrial was a place that we didn't play, even though we knew the strength of e-commerce and that you need 3 times more warehouse space as e-commerce grows. So if I look back at one regret of an asset class, that was it. What could have I avoided? We created this business in 2003 of creating these master plan resort communities. We buy big bulks around 2,000 acres. We would pre-sell lots, use that money to build these communities that had second homes, condominiums, 3 golf courses. I like the fact that we were high barrier to entry assets. I like the fact that we were major markets. And what hit us in 2000, and by the way, we were keeping low leverage because the thought was if we go into recession, since we had no debt on our balance sheet, we'd be the owner, like in Florida. What happened was in 2008, in the great financial crisis, there was no floor to these assets. So condominiums that we pre-sold 600 of them for $650,000. When the GFC happened, they became worth $250,000. Why? Because they were second homes. People were worried about their first homes. They could not absorb 2 body punches. The sickening part was I go to those communities today, 12 years later, they're on fire, okay? Reunion in Orlando, on fire. A deal in Naples, on fire. We were right. We just didn't have the right capital structure, and we were going after something that I said earlier. Rental assets only. We could balance cash flow and back end. And when you go into assets that are back end weighted, discretionary, non-necessity, okay? Second home, condo, golf courses, stuff like that. They didn't have the downside protection in a great downturn. And the essence of investing is avoid losses at all costs. No disasters. You need 90%. Number one, you got to protect the downside, which is you got to seek asymmetrical returns where risk is protection of capital. And then the alpha can be created through real estate execution skills. So you got to limit any losses. You need the bulk winners. That's a portfolio. And if you have a portfolio that's 50% high risk losers or 50% winners, that's a terrible portfolio. So if you stick to that thesis that I got to protect capital at all costs on the downside, and I could go for the alpha through value creation, that leads you to the case of you're not going to do the discretionary type residential resorts that we did in 2008. And to conclude on that, I was so sick about the results. I came in, obviously I never invested in that, and maybe people make money. I can't even look at a golf course today. Okay. It sickens me after we went through. So my point is, it was a tough lesson to learn, but it completely revitalized our company, which is saying we know exactly what we want to focus on. And but we thought we were protecting the downside by no debt and having a high barrier asset and pre-selling things in advance. We thought our strategy was totally downside protected. But when you have a great travesty like the great financial crisis, the rental assets rebounded, those don't, and that says it all. If that's the case, let other people do that and play with that. I could never live through that period. And I always say one more thing in that 2008 period. I say, in 2009 and 10 were tough years, okay? And we still had like $1 billion of buying power. So I said, this was my day. In the morning, I would wake up and all the asset management issues of these resorts, I said, come get it. Punch me, kick me, scream at me. I'm working my head off, but let me have it. At 1 o'clock, I'd have lunch, and I'm miserable all morning. I have lunch. At 2 o'clock, I go back, and now I go in the acquisition. I have capital. I can buy things at a bargain. So all afternoon, I'd be out buying things at a bargain, which we rebounded amazingly with the new capital. So that night, when I went back to bed, I felt great. Okay. So it was a way to work through 2 years. And then here's the last thing. Go into this. Real estate's a cyclical business. There's distress period, recovery period, and asset bubble period. 2008 was distressed. The recovery was 2012 to 16. Then we had asset bubble 17 to 19. And then we have distress again, pandemic 20, and distress again in 23. And here is the conclusion through 40 years of investing. You make the most money with the least risk during periods of turmoil of distress, because you can access assets and debt at a lower cost basis, hold your position, and ride the recovery. The biggest risk is when things are great, the asset bubble 17, where people are paying 25 times cash flow because of low debt. And then you go into a distress period and you're crushed. So what you learn, and this is the hardest thing to do, back up the truck in distress periods, not because it's contrarian. No, quite opposite. It's logical. If you believe real estate is a fundamentally good business over time, you go through cycles, but it recovers. The only time to access assets at a lower cost basis, having a better cost basis lower, is an advantage to competition. I'd rather own positions at 70% of value than 100%. If I could accumulate positions at 70 and ride up the recovery, it's a winning strategy. So the conclusion for all real estate people, every 10 years, work the first 3 years when you're in distress, take the next 7 years off, and come back. So that's how we'll conclude it for today.
All right. I got to ask you one question, then. You can answer it yes or no. Are you buying yet?
No, I'm doing preferred equity credit.
Okay.
You can't buy. There's no common equity deals. But doing preferred equity, I'm getting equity returns for credit risk. So and I conclude that asymmetrical returns is the dream of any investor in any asset class, whether you're in public equities, whether you're in energy, whether you're in venture capital, when you're private equity or real estate. And that opportunity exists today in real estate.
Dean, this was awesome. Thank you so much for today.